What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is October 7th of 2022. Well, folks, I hope you are having a fantastic day wherever you are, because in today's video, I just want to have a candid conversation with you guys about my genuine thoughts and outlook for crypto and Bitcoin over the next couple of months, because I know that it's generally already been difficult right now dealing with inflation and the slowdown in the economy. But to make matters worse, crypto has been in a bear market for nearly a year now. And I think a lot of people are confused about where things are going to be heading here in the near term, but also starting to question the long-term value of crypto. And I want to go ahead and provide my genuine thoughts here. Again, take it with a grain of salt. It's just my thoughts and opinion on the market. But if it proves valuable for you and you enjoy the conversation, consider dropping a like. It's a great way to support the channel. Now, I want to go ahead and focus here on the near term, because obviously for those of you who are invested right now, those of you who have maybe even some cash on the sidelines in which you want to invest in the financial markets, I know a lot of people are curious about whether or not we have hit a bottom. There is a group of people that are incredibly confident that back in June we set in those lows, and from here on out we've just simply got sideways accumulation or a potential breakout coming up here very soon in the near term future. And while, again, I will never take anything out of the cards here, I think it's very important to understand that while we went through a lot of really difficult periods for crypto with all the bankruptcies and restructuring that went on with major players in the crypto space, while there was the Terra Luna collapse that really hit the space and set this domino effect off, I think we need to understand as well what the macro environment is telling us and take a look back as to how we got to where we did. I think a lot of the answer of where we're heading can be answered by taking a look back at where we were just back a year or two ago, back at those November highs in 2021. Because it's no surprise that this sell-off has been brutal and has been a slow but steady drag down here as we've started to see the Fed have to reverse its policy decisions that led crypto up to these exacerbated valuations in the first place, going back here since 2020. We are still highly elevated from the range we were at here back at around March of 2020. We're still up more than twice that amount for Bitcoin's price here. And as the Fed is starting to reverse its monetary policy decisions, I would not be surprised if Bitcoin moves much lower. And this is why I want to talk a little bit about the macro environment. I don't mean to be negative here, as I'll get to later on. I'm a long-term pragmatic optimist. I see a positive future. I know that the chart goes up and to the right, generally speaking. But we need to understand, if we're asking about the short term, why I hold the thesis here that we're likely going to be moving lower in the near term. So let's just understand what's happening right now. The Federal Reserve at the moment is doing two things counter to what it was doing before. Previously, it was lowering interest rates and it was printing a ton of money. Quantitative easing. It is now engaging in the opposite through quantitative tightening. It is jacking up interest rates at the fastest pace it has done in the past few decades, since the decline of interest rates since as far back as the 1980s, with the decline of the federal funds rate. And on top of that, they are starting to reduce their balance sheet. They are starting to, month by month, get into a reduction pattern of selling off U.S. Treasuries and eventually starting to probably sell mortgage-backed securities. And no matter who's going to be buying these assets and at what price, essentially speaking, there is a certain amount they will be selling each month. And as the dollar value on these bonds or these treasury notes or the mortgage-backed securities decline, essentially speaking, that means the Fed's just going to continue to dump an equivalent amount in dollar terms. Doesn't matter how much that sell pressure is going to be, they've got to reduce that balance sheet, no matter what the dollar value is. And that's tens, if not hundreds of millions of dollars being evaporated from the money supply. Essentially speaking, the Fed is selling those assets in exchange for cash. And that cash is being reduced. It's coming out of the money supply. It's a way of quantitative tightening, cooling the economy. And the reason they have to do this is because of inflation. Inflation is still highly prevalent. You don't need me to tell you this, guys. You go to the grocery store, you go to the pump, you look at housing prices. Even with a supposed housing crisis on the horizon, housing prices are still ridiculous. Rents are absurd at these current levels. And it's showcasing that there is not a balance, an equilibrium between supply and demand. The Fed has not been able to get us there just yet. We're maybe getting closer to it. The Fed is on the right course, but it needs to take the driver's seat on cooling inflation. And because those principles are in play here of higher interest rates and quantitative tightening through balance sheet reduction, this is the reason why Bitcoin is declining and why it will continue to set lower highs or lower lows until the certain circumstances that the Fed is looking for, that perhaps they are starting to cool down inflation, that the economy is starting to slow enough where they've been able to rein in inflation back to their 2% target, which is, by many economists' viewpoint, a healthy range for inflation in the economy that can be maintained and is good for economic output. Again, everyone can debate that. At the end of the day, that's what the Fed is going for. And until they reach those targets, they will not start to pivot. I know a lot of people, for the past couple months, there have been waves of this where people get hopeful. They think the Fed's going to pivot. The Fed's going to stop tightening so aggressively because it's going to crush the asset markets, because it's going to crush the economy. Case in point, guys, the Federal Reserve needs to create a recession. I'm not looking forward to it. I don't think anyone is. But the counter to the sugar rush we had in 2020 and 2021 when everyone was an investor, there were Dogecoin millionaires, NFTs trading at hundreds of thousands, if not millions of dollars. The only counter to that is a dramatic downturn in the economy to cool all the excess money that's in the system. There's still so much in the system. Now, in order to understand if the Fed is meeting to its targets, we need to understand the two things that Jerome Powell has talked about. Jerome Powell has indicated two things that he is watching here. Now, there is a lot of other metrics that the Fed keeps track of. I wouldn't doubt that for a second, but there are really two things that the Fed's watching: inflation and the jobs market. Essentially, are there more job openings or less job openings? Is there a higher unemployment rate or lower unemployment rate? Well, let's go ahead and talk about inflation here. Year over year, the PCE, which bear in mind is a lot more easy to get down to 2%. That's why Jerome Powell likes this one versus, say, that of the CPI, which is sitting more around 8% to 9% year over year, right? The PCE here, which has a lower weight on rent or housing costs, is still remaining relatively flat here, elevated 6.25% year over year. Now, I know a lot of you are wondering, hey, Nick, what's the month over month change? Well, month over month here from July to August, we actually saw an increase in the PCE. Now, again, a lot of people are looking for a pivot here and for that position where the Fed could really start to kind of ease on its hawkish approach to monetary policy to counter all this excess money and credit. If the PCE is not in negative territory like it was the prior month and starting to see minus 1% month over month, minus 2%, we are far away from a pivot. If you're expecting the Fed to change course here by the next FOMC meeting or two, you got another thing coming to you unless the metrics really start to change here. This is not a region where the Fed can start to cool. If inflation is still ticking up month over month, the Fed's in big trouble, and it needs to start, rather than hiking by 75 basis points, it needs to start taking over the driver's seat and taking it to 100 basis point hikes. And yes, it's going to be painful, but nothing is more painful than hyperinflation and losing all trust in the existing monetary system. I know a lot of people want to see Bitcoin replace it, and there's a chance that Bitcoin could do that. If the Fed starts to pivot too early, that's where I might start getting really eager to look at crypto, ironically enough. In the meantime, though, we have to understand that the Federal Reserve knows its course. It just might not be acting too aggressive on it. So we understand that inflation is out of the question. This is not a sign for pivot. But what about today's jobs report that's going to be coming out here in a couple of hours? Could we see potentially a weakening, a softening in the labor market that's going to get people really excited? It's what gave a lot of people excitement back a couple days ago, as we essentially are starting to expect that the labor market is cooling. We got a preview of this because of the decline in job openings. There was about 1 million jobs removed from the market, essentially. So 1 million job openings that companies had listed have been removed, and that is leaving less economic opportunity for employees to go out and get a better salary, essentially. There's less competition on the market, and that is ideally going to help not only to cool the labor market, which is one of the Fed's statements, but there's a reason why they want to see a softer labor market. It means less wages in the economy to go out and spend, meaning less demand, less exacerbated demand on the existing supply for goods and services. A slowdown, a recession, that is what the Fed needs to see. Now, a lot of people are excited here about potentially receiving, in this case, a higher than expected number layoffs, or essentially lower increases month over month. Right now, they're only expecting 275,000 new payrolls in September, holding at an unemployment rate of 3.7%. But I gotta be honest with you all here. While there is an opportunity to cause an upset here, essentially, that would be beneficial for the bulls. Ironically enough, just to kind of provide some context here, in this case, as the headline reads, bad news is good news for the bulls. And this is, again, just like why I hate I guess our fascination with, oh, how is my asset price doing? How is my stock investment doing, right? I'd rather, essentially what this headline is saying and what the markets are hoping for here is that there are going to be more people laid off in the economy, because if there's more layoffs, that's going to prove that the Fed is heading in the right direction and that they're going to be able to essentially pivot now, that they're going to essentially be able to start lowering interest rate hikes. They're going to start reducing their balance sheet reduction. And this is the kind of cynical thinking that is just going to wreck a lot of bulls in the market. I mean, you guys can love crypto. I love cryptos. I'll get to in a bit. And yes, I'd love to see crypto prices start to recover. I'd love to get back to the times where you can, again, invest in the market, make solid returns. But folks, even if we do get this upset here, where there is lower the amount of payrolls than expected, we need to understand here that, as we looked about in the chart the other day here for those job openings, we are far away from the situation where the Fed can pivot. The Fed is not going to pivot from 1 or 2 months of decline in job openings. They're not going to pivot for 2 to 3 months of declining inflation. They have made it very clear that until metrics like the PCE hit 2%, they are not backing away. They don't care if they're going to put us in a recession. They don't care if there will be some contagion. Some companies like Credit Suisse and Deutsche Bank, I've heard a lot of people talk about it. You know, that you've probably heard in the headlines that these banks are potentially up for major bankruptcy or restructuring. Essentially speaking, if they get knocked out, they get knocked out. There's going to be collateral damage here in the world of finance for players who took too much risk. And again, as we talked about earlier here, while I'm not bashing Bitcoin or anything, we need to understand from a risk on to risk off metric, or a kind of line here, essentially, if you will. And you take all the assets that exist out there, like bonds, treasuries, which are all doing very well right now. You take a look at the opposite spectrum. You take a look at high-risk tech stocks, cryptocurrencies, NFTs. All of them are getting crushed right now. And the reason why is because it's not an environment to get optimistic on these things. Now, if we were in the same situation we were for the last 10 years, where the Fed could come to the rescue every time something bad happened, then yeah, I would still be betting on those riskier plays, right? We might think that crypto's not risky, or we might think that Bitcoin is actually less risky than fiat currency because it's limited in supply, all these fundamental narratives that we have. But case in point, guys, to the broader world, crypto is still a niche asset. It is a less than $1 trillion asset class versus that of real estate, which is hundreds of trillions of dollars. The bond market is over $100 trillion plus if you can consider treasuries and other government bonds. This is a small blip on the map here. And the rest of the world, it is seen as a speculative asset, especially if you get talking about altcoins or NFTs, which there's still so much excess valuation at the moment. It's just being realistic, guys. In this environment where interest rates are going to have to be jacked up for some time and the balance sheet needs to be heavily reduced to get rid of a lot of the fluff in the economy and put us into a proper, necessary recession to cool inflation like we did in the 1980s, NFTs, altcoins, and probably even Bitcoin in the broader crypto space are not going to do well. Now, that's the near-term outlook over the next couple of months. Just trying to set the stage here. But on a positive note, I think that there is a very good chance that we could eventually see a brighter future for crypto at lower valuations. But we need to see those two factors that the Fed is looking for being met. Because once they're met, once we're at that stage where, ironically enough, no one will want to be buying crypto at that time. Everyone will be so afraid when Bitcoin is down at, say, for example, $16K, $14K, $10,000, which is our real kind of target range here, 10 to 12K. This kind of pocket where price had accumulated here back in June of 2019 or here in September and October of 2020. When we get to that range, no one's going to want to buy Bitcoin. Everyone's going to think that crypto's going to zero, it's over, it's done for. That's the kind of range where I get really excited. The unexpected capitulation. That's where you get generational buying opportunities. When no one else is willing to pull the trigger, but you will. Because you've been keeping your cash on the sideline, you've been waiting for the market to come to you, and you understood the macro scenario could put us in a case where that actually plays out. And I can't tell you guys if it's going to hit those exact price levels. I'm not saying to wait for one particular price, but have your standards set a little bit higher here. This isn't a typical buy the dip opportunity. Many of us haven't lived through these kind of corrections. We've never seen crypto go through a 40 to 50 to 60% correction in equities. What is that going to spell for crypto, which, whether we like to admit it or not, is more risky? It's more new. There's no revenue backing up crypto. It's an asymmetric asset. And unless the narrative is the Fed's printing, interest rates are low, there's excess money, I need to hedge inflation, it's not going to be a good scenario for crypto. But when those elements do change, when they do finally start to materialize, when we get peak capitulation here, when people think that the Fed's just going to keep tightening and cripple the economy more and more and more, that is when I'll start to dollar cost average. Right now, there's just too much optimism in the system. I don't know how else to put it, guys. Still too many people confident that this was the bottom here. And I'll be honest, as a point of self-criticism here, you guys know it, as if you've been watching the channel the past couple months, I thought 30K was this unbreakable level. I thought we were still in the bull market back then. I'll be honest with you all, it's the same exact philosophy here that's playing out on so many people. It's a big mistake. And it's something that, again, it's easy to get caught up in, especially when you're invested in something, right? And again, if I'm wrong on this, at the end of the day, if Bitcoin breaks through this line of resistance and starts to send higher lows and higher highs, I'll pay a premium here. I'll go back into the market heavier than I ever have and stuff if I see the right signs. I don't mind paying a slight premium. I don't mind buying somewhere above the bottom because there's going to be one genius out there that nails the bottom. And I know that I'm likely not going to be him, nor will any of us on this channel likely be that person who picks the bottom perfectly. So, again, guys, we will continue to cover a lot of these interesting talking points to kind of build this up and build this thesis here on the channel. Things from the energy market to housing, currency markets, you name it. But that's going to be it for today's video. Thought I'd keep this one pretty simple. If you guys like this kind of outlook here, definitely consider dropping a like and subscribing. And if you like my rambling, you might also like it in written format as well. And you can check out the Dash Report. The Dash Report is our newsletter here on the channel where I cover everything we just talked about, from crypto to equities to even covering areas like commodities and Forex. And not only do you guys get the monthly newsletter where it's about 15, 20 pages where I'm really just kind of diving through the market, but on top of that as well, you'll get access to the alerts group. You guys hear when I make some trades in crypto and equities, as well as getting access to our exclusive market updates that we send out to our Telegram members. And also you'll be able to join the discussion group, the mid-month webinars, all kinds of stuff where you guys can get to ask me a lot of questions, and we'll dive through the charts together and everything. So it's really, really cool thing. I love the community we have. We have a lot of participants in there, some of our most avid members of the DataDash community. But until the next video, everyone, thank you all so much for watching. If you want to check out the Dash Report, it's at the link down below in the description. You can find it at nicholasmerton.com/Dash Report. But that's it for me today, guys. I hope you have a wonderful weekend. I hope you can see that I have the long-term passion and optimism for crypto. Bear market or bull market, I'm going to be here with you guys, and I can't wait to see what the future has for us in the cards. Take care, everyone, and I'll see you all later.